All right, so I'm going to start now. If you would have seen on the eLearn, you will see that the chapter, earlier I had uploaded one in one lecture, but now we will see there are two parts of the same chapter because we couldn't complete in the last lecture. So now you have two files there on eLearn. And there are some additions to the old file, so you can download the updated one, updated two files for this chapter. They are called lecture 2 and lecture 3. The chapter that we are discussing, we started discussing in the last class, is to understand the theoretical framework of financial reporting. What are the factors that affect the reporting, financial reporting by companies? So we saw a model in the previous class that based on the objective, firstly, we have to understand the objective of reporting. So that's the first and main part of the conceptual framework that we need to understand. Why are we making financial reports? What is the objective? Who are the users? Okay, so that's the first part. Then based on the objectives, we saw that there are three factors that affect the development of financial standards, financial reporting standards. Of these three, we covered the first in the last class, and we have to now cover the remaining two. The first factor that affects the financial reporting, that is a very important factor affecting the financial reporting, which was the qualitative characteristics of the financial statements that we make, the financial reports that we make. Silence, please. The financial reporting qualitative characteristics are the factors, are the features of the report that make it user friendly, because as we saw in the previous classes, that the financial reports are to be prepared by economic entities for user groups. These user groups are primarily the investors, the lenders, the creditors, and also other stakeholders. So in order to make the reports user friendly and the information relevant and understandable by the stakeholders, different stakeholders, we need to incorporate some fundamental characteristics of the report in the reports, and some enhancing characteristics which make the report more beneficial to the stakeholders, and both of them together are called the qualitative characteristics of the financial reporting. So we studied that in the financial characteristics, in the qualitative characteristics, in the fundamental, there are some basic items without which the financial reports are not acceptable to the stakeholders. If you, for example, many of you participated in the discussion on Mobily, and due to some factors, I have seen the answers, but I have to still I have to tell you who the two each from each sections are who got the bonus. Now, what is the problem with Mobily? Mobily misreported. There is a basic problem of misreporting. Ethical issue is there. So such reports are not acceptable. If you are not reporting the right things, you are hiding the facts. So the qualitative characteristics we discussed in the last class. Now we have to come to discuss the two remaining factors that affect the theoretical framework of accounting financial reporting system. But I just wanted to quickly cover review the quiz questions. So if any one of you has I saw that the scores are wonderful. All the sections of the girls have scored about 100%. Most of you, except one or two in each section. Whereas on the boys' side, it's a different. It's not so. They have done well, but it's not as good as yours. I don't know what is the reason, because it is something exceptional, extraordinary well, because the result is almost 100% for all the sections in the girls. So I accept that. I am sure you have honestly done it. You didn't help anyone or looked into the slides before writing the answers. So let's review the quiz questions before we go to the two factors affecting the theoretical framework. There was a question that accounting means recording of what? Recording of both income and expenses. And then the second question was the accounting body responsible for developing standards for Islamic financial institutions. It is the AAO, IFI. Accounting deals with just recording the financial transactions of a company? No, not correct. It also deals with analysis, tax advice, etc. Then which is not correct regarding the information accounting provides? That it does not provide information on employees' qualification. The other name for a statement of financial position, that is balance sheet. Then there was a question, IFRS is applicable to companies in USA only? No, it can be applied to companies because IFRS has been developed to actually to be applied anywhere in the world. So this standard has taken into account many different countries and companies. Then financial information always relates to economic entities. Obviously, those entities which are dealing with money, only we need financial information for them. Others are not applicable. For others, it is not applicable. Then economic entities can be both private or public. Yes, they can be both private or public, meaning that a government also can be an economic entity, an individual also can be an economic entity, an institution also can be an economic entity. Okay, then the question was the common name for equity. It is share or stock, both are correct. Shares, the common name for equity is shares. Among the user groups of financial information, the companies that produce the same service or products are called competitors. So they are also using our financial information. Accounting conforms to social norms also. Yeah, true. They are affected by social norms. What is the main difference between basic accounting and intermediate accounting? Intermediate accounting deals with more complex items of assets and liabilities. So these were the questions which was there in the quiz, and most of you have answered correctly. In fact, for the uh, girl side, for your section also, it was almost 100%. So congratulations for an excellent performance, and I hope you will keep it up. But there is one advice to all of you before we move ahead, that when in the next quizzes, just for your reminder, I hope you have not done this, but do not help your friends and do not look into the slides while writing the answers. Check your own memory, because in the quizzes for your side, we cannot be invigilating you. So it is up to your honesty to do it yourself. And don't worry about the grades. The grades are not so important as is your learning. So unless you do it yourself based on your memory, the learning will not be that much. So at least don't help your friends. Even if you are writing by seeing your slides, don't help your friend. Let them answer themselves. Okay, so now coming to the elements of financial reporting, which was the second factor affecting the conceptual framework of financial reports, and they are the building blocks of financial statements, and they are the actual items which are reported in the financial reports. So what has been done is that these elements of financial reporting, the contents of income and expenses, the revenue and expenditure, have been classified into two categories based on their time. So first category, now this is your first task for today, first lesson, to learn, to memorize. Okay, so the first point that we have to learn for today's class is that the elements of financial reporting are classified into two parts, which are the point in time elements and period of time elements. In point in time elements, we call them the balance sheet components, and the period of time elements, they are the income statement components. So that is the first point that you should memorize. Okay, so elements of financial reporting are the building blocks of financial statements. The elements of financial statements are divided into two based on when they are reported. So the balance sheet components are reported at one point of time, whereas the income statement components or the income statements are reported over a period of time. So that's the first point you have to remember. Now the balance sheet components, when you are quite familiar with the balance sheets, and the most common names you have ever heard in a financial accounting system is the assets, liabilities, and we are seeing this name from the very first day in the course outline. When we were discussing the learning goals, we started discussing about the assets and liabilities from there on. So now we are coming to exactly where they are in the financial reporting. So they are actually reported at one point of time for any company. In a financial year, they may be reported in the quarter or half year or annual. And what they contain are the assets, the assets, the liabilities, and the ownership of the shareholders, the owners. The assets are we have also discussed them earlier. The assets are the all those items that the company owns, OWNS, owns. And the liabilities are all the items that the company owes, money that the company owes, it has to pay. A technical definition of assets as per the book is that the assets are probable future economic benefits controlled by an entity as a result of a past transaction. So the past transaction may be sales, sales resulted in income, income resulted in profit, the profit has been kept as reserves, profit has been kept, some profit is given as dividends, and the rest are kept as surplus or reserves. This profit reserve, the surplus, becomes asset. So we understand that the past transaction was sales, was sales by selling some assets. So by doing any income generation activity, mainly selling, we are able to create assets for the company. And assets are probable future economic benefits. So this makes the definition of assets very wide, and it contains all aspects, all types of assets. Because normally, in past, when the accounting system was not so developed, the companies used to believe that only the cash they have is the asset, that the cash that they have been able to save or the profit that they are able to save is the asset. But then they later realized that no, the accounts, receivables may also be an asset, the inventory is also an asset, share capital, the money they have in the bank is also an asset, plants and machineries are also an asset. So when we are, so when we have recognized so many types of items as assets, this definition makes it covers all the types of assets. So assets are probable future economic benefits. Future economic benefits. Now, for whom and what is the condition? The condition is that it must be controlled by an entity. It must be in possession of the company, of the economic entity. And the third point in this to notice is that it is a result of a past transaction. So there are three parts. There are three parts to this definition. Number one is that there is an economic benefit, future economic benefit. Number two, there is a control by the entity. And the third one is that it is a past transaction. So there are three main elements that define an asset. So if you say that assets are only those which are there with you, the money that you have just now, no, that is not just asset. Assets are more than that. Assets are things which we can sell later, which we can use for future. So all those items that I own and whose benefits I can enjoy in future are called assets. Then comes liabilities. So in the past we discussed liabilities as something which we are supposed to pay. There is an obligation. So the definition, the technical definition of both assets and liabilities, you can see, are similar. They are similar, but the only thing is they are opposite. In case of assets, it was economic benefits. In the case of liabilities, there are future sacrifices. In the future sacrifices, you have to pay. So where in assets you were supposed to receive, in liabilities you have to pay. But in both the cases, these liabilities or obligation are also a result of the past transaction. So suppose you purchased a raw materials from a supplier. Now you have to pay. So, but you are not paying instantly. The supplier has given you 1 year time to pay back. So you note down these items in account payable, and that becomes a liability for you. You have to pay it. Similarly, you take loan from the bank, and the bank has asked you to pay installments. So this installment, the loan money that you have to pay in the next year, also becomes liability. So these are all because of your past transaction. Because you took a loan from the bank, it has created an obligation for you, and that has become a liability. So the definition, if we look at both the definitions together, we see that they are just opposite of each other. And you are all supposed to memorize these definitions for the exam. So if we define assets, assets are the probable future economic benefits. Liabilities are probable future obligations. Assets are controlled by an entity, benefits controlled by an entity. The liabilities are the sacrifices that the entity has to make. Assets are also a result of past transaction. Liabilities are also a result of past transaction. Now the third point, the third item is actually the result. The third item is actually the result of the performance of the company, how the company is performing. So they are running a company, the company has its own land, plant, sales, they are making profit, etc. And these items are converting into assets. So the company is increasing in assets. Then they are also increasing in liabilities. There are many things to pay. When we subtract the assets and liabilities, we see that if the assets are more, if you have more assets, if suppose you have, if you have 10 reals as assets and 5 reals as liabilities, that means after probable paying off. So what we have to understand that assets and liabilities are probable. We have to predict that is the present status, and this, if this happens, if all of them come to ask for money tomorrow, right? So are we able to, suppose you have 10 suppliers, all of them will ask for money, but somebody will come next month, somebody may come next to next month. But when we are calculating our balance sheet, when we are making a balance sheet, we have to write down liabilities for the next full year, assets for the next full year, and then see, are we ready to pay for all the liabilities that will come in the next year? Are we able to pay back all the obligations that will be outstanding in the next year? If yes, then we will see if we have more assets left, if the value of assets are still available. So obviously a good company, a company like Microsoft or Almarai or Bin Laden, they have huge assets. So you can just check their balance sheets, and you will find that their assets are much more than liabilities. So that means, the remaining, the result of the difference between assets and liabilities will be the money that is left with the owners. So the owners can now say, the shareholders can now say that this is my money, and this is how, this is the ultimate, right? This is the ultimate form of benefit. This is the ultimate result of the company. Why have I started a company? I have not started a company only to meet the liabilities and assets. The main purpose of starting a company is to make profits, to increase the wealth of shareholders first. So that's what balance sheets say. Are you able to increase the value of shareholders' money or not? So every year we make balance sheets and we check how much equity is left. The net assets of the business after you have given the liabilities, after you have subtracted the liabilities, how much money is now left. Now money, don't take me at in literal terms. I mean, money, I don't mean cash. I'm talking about money in terms of assets, full type of assets. And then we see how much value the owners are left with. So there's the second point that you have to learn. First was that the elements of financial reporting, which are the building blocks, can be divided into two types on the basis of time. One is the point in time, and the other is period of time elements. Balance sheets are what? What type of elements are these balance sheets? Yeah, but means out of point in time and period of time, what type of element is balance sheet components? Is it point in time or period of time? Point in time. And period of time is the second type of component. They are the income statement components. Then, in the elements of financial reporting, we have seen basically that balance sheet components are just three. First is assets, second is liabilities, third equity. Now let's just revise the definition of both of them so that equity is clear. Assets are probable future economic benefits. Yeah, as a result of a past transaction. All the class should memorize this definition. There should be no hesitation in reading lot of times, and it will be very easy for you to memorize, because we need to memorize the definitions of some technical terms. Now if you memorized assets, liabilities will be easy for you to memorize. What are liabilities? Liabilities are again probable future sacrifices of economic benefits arising from a present obligation as a result of past transaction. So just for your what you can do, since example is not given here, what you can do, assets. Now give me an example of asset, write it down there in your notebook or the printouts that you have. Give me one example of asset. So write down cash there, just write down cash there, or somebody can write plants and machineries of the company, raw materials, anything, whatever you feel like, just write an example of assets. Similarly, in the liabilities side, write down some example of liability that you have to pay in the next year. Tell me any liability. Give an example of liability for a company. Bank loan, yeah, you can write bank loan. Bank loan is account payable, the money you have to pay to suppliers. These are all. Salaries are not in the liabilities side. Salaries will be, yeah, salaries will be in the expenses side. Now, when we understood assets and liabilities, equity is very easy. The definition of equity is the net assets of the business, and it is calculated by subtracting liabilities from assets. Liabilities from assets. So this will look like, the most important here is the formula that is given at the bottom. But just to summarize, I have written down this explanation of what we have discussed, so that you can later on, just recall what we discussed in the class. That the balance sheet shows, you don't have to memorize this, okay? Just read this so that it is clear what we have discussed. That the balance sheet shows the current financial position of the firm. And when they say financial position of the firm, what should come to your mind? The assets and liabilities of the firm at a given single point in time. At a given single point in time. So if I get the balance sheet as on 31st March 2018, then that means this is the position as on today. It is also called the statement of financial position. The structure of the balance sheet, what is the structure? How many columns we have? Two. One is asset, the other is liability. While on the other side, liabilities and shareholders' equity is shown. Shareholders' equity is on which side? Asset side or liability side? Shareholders' equity is on which side? Asset side or liability side? Yeah, of course, it is on liability side. So the shareholders' equity, which is the net assets of the company. How do you calculate the net assets of the company? By subtracting liabilities from assets. Okay, and there is a final rule in the balance sheet, that the two sides of the balance sheet must be equal. So if you have more assets, less liabilities, then you will add shareholders' equity, and then it will become balance. So the balance sheet components were the first. The balance sheet components were the first type of first component of financial reports, which are called the point in time components, point in time elements. The second one is period of time elements. The period of time elements are the income statement components. Income means it's not just income statement, it is both revenues and expenses. But as per the new standards, we call them the income statement components. Yes? Any problem? Okay. So the income statement components are actually not just a picture of one point of time, but it gives you a picture of a period of time for one full financial year. And they report both the revenues and expenditures of a firm. Actually, the balance sheet is the last part. The first part is the income statement, and then it results in the balance sheet, the preparation of balance sheet, because actually it will be the profit, then the profit will go to the balance sheet also. So in the past, the name of period of time elements, the income statement components, was profit and loss account, P&L account. The income statement has 7 elements. Like the balance sheet has how many elements? 3 elements: assets, liabilities, and the equity. So in the case of income statements, what is the past name for income statement? Previous name? What was it called earlier? What was the name of income statement before? It was called profit and loss account. Okay, so the 7 period of time elements are, these are the 7 items that you will see in income statement. These are, number 1, the main headings of income statements are investments by owners and distributions to owners. Investments by owners in the form of shares. So they buy shares and their money is placed as capital in the company. So the capital goes to the assets and liabilities side, the balance sheet side, and the regular investments in the annual investment, they are shown as the investments by owners in this year. Similarly, in this year, if we have given dividends, cash dividends to the owners, then this will be shown as an expense. So you understand the two terms like shares and dividends. All of you understand shares and dividends? See, shares are the ownership in a company. Now, if I want to run a company, what is the main resource required to run any company, to start a company or run a company? Capital, yeah, capital, money. Now, money can be my own money, or also I can do two things. I can either take a loan or I can sell my ownership. So selling my ownership is now a very common practice, which is called share. So if I am a company and I want to take money from public, I tell them, okay, you buy my shares, become a partner in my company, and I will give you dividends. I'll share profit with you. And this share of profit, annual profit, is called dividends. So the shares or the stock or equity is the ownership in the company. And when we were talking about loans, there is also an option to take loan from banks. If I take loan from banks, what will happen? I'll have to pay back, but they don't become owners. They are called lenders, lenders or creditors. So if the banks or any individual has given us loan, then they have no right in my company. Their only right is to take back the money they have given, and that is the liability for me. So distribution to owners is in the form of dividends. Dividends is the percentage of profit that I decide to share, annual profit that I decide to share with my shareholders. So that comes to the shareholders. Revenues are the third period of time elements, income statement component. Revenues basically come from sales for a company. So when I sell products, my products, it may be goods or services. I am Saudi Airlines, so I sell tickets. That is my main sales. So that is my revenue, and that is why any business, they ask you about revenue model. How will you earn money? By selling tickets, or you can also make money by selling ads. So this way, you are making money for the company. That is your main source of income. These are called revenues. Sales is the one. Fees is also there. We can take fees. Takings, we can, there are some commissions, some other form of income for the company. These are all reported as revenues. Then in the financial reporting, you will also see that there is an item called gains. Now gains are different from profits. These are gains which you make by doing your non-core activity. Your main activity is to sell products and services. But then you also, the company also does other activities, like they also sometimes they buy shares, sell shares, investment. They do this. The companies also buy and sell shares. The companies also sometimes they will buy land, or they will buy some hotel and then they will sell it next year. All of these transactions are not the core transactions of the company. These are investment transactions. So when you do something non-core and earn money, earn profit out of it, you show it as gains. Okay, they are shown as gains in the income statement. Then the fifth one is expenses. The expenses are, examples are rent that we pay if we are paying rent, the wages, the wages are an expense. Cost of goods sold, they are also expense. So they are reported in the expenses. Losses are the opposite of gains. So for example, I purchased land, I had money, I had cash. In my last balance sheet, I saw that there is cash. Then I decided, the company decided to buy land somewhere and as an investment. So now this year they decided that we are going to sell this land because they needed money or whatever reason, but the land was sold for less amount than for what it was purchased. So then that means there will be a loss. But this loss will be reported as an item called losses in the income statement. It is not the normal loss by selling and by the operational activity. It is a loss because of a non-core activity. Then the seventh and the last one is the comprehensive income. So comprehensive income is the change in equity in 1 year. Change in equity without any new investment, how much the wealth of the owner has changed. So change in equity in 1 year from non-owner sources. Non-owner sources means the owner has not spent money in the company. What has been the change in the shareholding pattern, share capital in share income of the company? It is not necessary. Please listen carefully, because I am also recording this lecture. So if you disturb that, the recording will not be clear. So these items are not necessarily all be there. It's not necessary that gains are there because the company has not sold any long-term asset this year. So there is no gains, but the gains item will be there. It will be reported as zero. Losses, they have not sold anything this year, so losses will be reported as zero. So what we have to understand that in the income statement, the other name of period of time elements, there are seven items which will be there. What you do, you have to memorize them with examples. So don't forget the examples which are written there. These are given in your book. So just memorize the examples and the items. Investments by owners, common stock. Common stock, if you are not clear, just write shares. Equity shares or just shares in your paper or notebook. Just note down, they are shares. Distributions to owners, dividends. If you don't remember what is dividend, you can write down percentage of profit given in the year. Percentage of profit. Now, how do you give? What are those that you can learn in? There will be one chapter here also, and mainly you will learn in the financial management, Idaratul Maliya, where you learn in detail how dividends are calculated. How do you decide how much dividend you should pay? Revenues, sales. Just remember sales. That will be enough for you to understand what revenues are. Gains. long-term assets when you make profit. Expenses are rent, wages, etc. COGS is cost of goods sold. So if you want to remember, write it down there, cost of goods sold. Losses are the opposite of gains. So when you make money by selling long-term assets, you can also lose money by selling long-term assets. So when you lose money, you write it as losses. They are also in income statement. And the comprehensive income is change in equity in 1 year. So these are 7 period of time elements which you have to memorize with example. Now we are coming to the last factor. Yeah. Pardon? Examples of point 4 gains. Gains, yani, what happens, as I said, if the company has more money, suppose I made more money, I have say 1 million reals, I have extra this year, I say why not buy, suppose I buy shares, okay, or I buy some asset, suppose I invest in some currency, or I buy share, I buy land, and when I buy land next year or after next year, after 2 years, this land I plan to sell because I feel I am in need of money, or for some reason I have to sell the land or the shares. Now if I made profit by selling the shares or the land, then I will report it in gains. But if the money that I earned is less than the money I invested, I'll have to report it as losses. So this is how in income and income statement I will report them. Because I bought the land for 1 million, I sold it for 110 million, so I'll report it as gains, 10 million gains. But if there is a loss, I'll report it as a loss. So these long-term assets are land or machinery or shares, anything which you are not going to sell in a day or two, that you want to keep for a long time, and then when time comes you will sell it. So these are long-term assets. Okay, so coming to the last point, the last major factor. So let's revise again. First is qualitative characteristics. We are going to the last week's lecture. Qualitative characteristics are of two types. One is mandatory, yani fundamental characteristics. The second is enhancing characteristics. Then the second factor affecting the financial reporting is elements of financial reporting. They are point in time elements and period of time elements, the balance sheet components and the income statement components. Last factor that affects the development of accounting standards are the principles of recognition and measurement. So you have to remember these terms: qualitative characteristics, time elements of time, and the principles of recognition and measurement. That is the last part. Now in accounting, there are two methods of recording income and expenses. Either we can write in terms of cash, or then later in the more advanced method of writing down the transactions is called accrual accounting method. Both are different. In the cash accounting, it was simply when we get money in the form of cash, we note down that the income has been received. But in the accrual, they were also taking into account the different types of business models, because there are business models. in some business models, the cash is not readily received. The cash will come after some time. The cash will not come immediately. After you have sold the product, the cash will come later. Mobile phones, postpaid. I have provided the service, but the money will come after 1 month. After I'll do the accounting and you have used the phone, then the company will, in the electricity also. What happens? It is not cash accounting. You provide the service first, and then the company, Saudi Electricity Company, they will come and read your bill meter, how much have you consumed, and then they will go and calculate. Then you will pay, but the use of the service has already been done by the customer. So based on different business models, accounting system then decided, the standards, the Financial Accounting Standard Board and the accounting standards, they felt that there is a need to change the accounting. So the new accounting system is called the accrual accounting system. The cash accounting is an old form of accounting where the accounting was done only on the cash basis. But in the accrual accounting, there are 4 principles. The first is the recognition of income and expense. So as per the standards, the income and expense must be clearly defined and recognized by the accounting standard first. Number 2, if it is recognized as per the accounting standard, it is recognized that yes, this is an income or expense, then we have to also think on how it will be measured. What will be the basis of measurement? Because the business has changed a lot and the business has evolved. So accounting system had to take into account many aspects of this cost or the income or the expense. Example, advertising, marketing, sales promotion. Now the sales promotion has changed. Sales promotion is of different type. They give you 1 for 1 free. They also sometimes give you 50% off. How to recognize this? Is this an expense? Is this an investment? So when we have to take into account the writing down of the transaction, we need to check whether it is recognized as a revenue or expense, and also how should this income or expense be measured. So there are 4 principles in accrual accounting. So when we talk about recognition, that is the first principle, how do you say that a particular item that you spent is really an item to be reported in the financial statement? So they have given a definition of recognition, and you have to now again memorize the definition. That recognition is the process of reporting an economic event. Economic event means either you received money or you gave money. Is the process of reporting an economic event and is included in the financial statements. Okay, so recognition. If the word recognition, as per the accounting system, accounting standards, is very clearly the process of reporting an economic event. Either I received cash, either I received money, or I gave money, and also they form the main part of the financial statement. They are not like for example, I hope you are now familiar with the financial reports of the companies. So every company publishes annual report. In the annual report, they will first write about balance sheet, income statement, all 4 or 5 pages. And then there are a lot of pages to explain, and one of the explanations we saw in the last class, in the case of Johnson and Johnson, what they did, they gave an explanation of the assets. So in the income expense also, we have to clearly identify if is this an major expense or revenue to be reported in the financial statement or not. So if it is reported in the financial statement, it is called recognized revenue or recognized expense. So when does this recognition occur? When it meets the definition, it can be measured, it is reliable, and it is relevant. You have to memorize these 4 factors on which you can say that this item is recognized as revenue or expense. But these are all, as a manager, as a business manager, I don't need to apply them practically, because they are already done. What we are learning in this chapter is how they did it, how the accounting system did it, what were the factors. So after we have understood them, it will be easier for us to use the reports, to prepare the reports. But as a business manager, we are not going to make recognition. Recognition has already been done, whether inventory is an expense or income. So recognition, what we are learning is, what is recognition? Recognition is the process of reporting an economic event and is included in the financial statements. That means this is a recognized revenue or expense. Now, revenue has got 2 shapes today. Revenue, earlier they used to feel that revenue means everything that you receive in money. It's not so. Revenue can also be today, can be classified into revenue that are direct cash, or they are to be paid back. Like, for example, I gave you a money example of postpaid connections in telecom. Now, postpaid connections, what are they? They are not immediately converted, but they will be earned. Now, here I'll try to just simplify and answer the question on Mobily. The case of Mobily was a problem of recognition of revenue, bad recognition of revenue. What they did, and it was a fraud, or it was a problem, because Mobily did it deliberately. They did it deliberately. They did it to increase the profits. So in the case of prepaid coupons, prepaid cards that we buy from Mobily, 10 reals, 20 reals, 50 reals, what they did, even though the cards were not sold to the customers, they reported them as sales. Are you understanding? We buy prepaid cards from the grocery stores, from other places, and then we use it. We scratch, and the number we press the key in the mobile phone, and then it is recharged. But unless the customer has purchased the prepaid card and used it, Mobily cannot report it as sales. Mobily cannot report it as sales. But what they did for many years, for not just 1 year, for many years they reported this as sales. And then what happens, if you report more sales, you will report more profits. So if you report more profits, then all other figures will be affected. So then the scandal was found. The CEO of the company, Mobily company, was fired, and that was the news I shared with you. But I wanted you to basically research and find out what is the main reason for the problem. The main reason was revenue recognition. So they were not recognizing the revenue as per the standards. And not by mistake. They did it deliberately, because there was an auditor also who was involved in this. So realized revenue means cash, and earned revenue is the revenue that will come to me even though I have completed the transaction. I suppose, a very nice example is the there is there is a travel consultant, travel operator called Tayyar, and Tayyar has a tie-up with Ummul Qura, and Tayyar is the sole tour operator for making tickets for all the expatriate faculty members every year. So what they do, they already book the tickets, but they will receive the money after the transaction is complete. But they will report based on the income recognition standard, they will report the transaction as complete once the contract is signed with the jammer. So we must have to take into account the realized and earned, both types of revenue in the accrual accounting system. And there is a realizable revenue also, that you will receive the payment for the product or service later. So realized and earned revenue are two types of revenue which we have to recognize in the new accounting system. Secondly, on the expense side, there are three types of expenses. One is that you have to pay. Example is given there. Remember the example, wages. Okay, wages and salaries are different. Salaries are fixed. Wages are not fixed. Wages are variable. Then there are some changes in asset. Changes in the value of asset. That is also to be reported as expense. Or you have a new liability associated with economic benefit, like for example expiring prepaid rent. So you paid rent for your some premise or something, but now you have a rent coming up. That also has to be reported as an expense. So expenses are basically the money that you have to pay within a financial year. So you have to report them, and that has to be recognized by the accounting standard. Now, once the income and expense are recognized as per the accrual accounting system, now comes the question how to write down the value. Whether we should write the full value, whether we should write the discounted value, whatever. So when we write the value, first of all, the example is like, for example, inventory. Now, inventory will be shown in the balance sheet on the which side? Assets side. Assets. It is an asset for the company. Inventory. But inventory can be shown there with associated costs, because inventory is not free. So when I am showing 1 million reals of inventory in my balance sheet, I have to also show 20,000 reals of cost of maintaining the inventory in the income expense side. So that's what we have to understand. So when I want to write down the value of inventory, I will have to take into account these four measurement bases. Historical cost, we have to see what was the cost earlier, on the basis of which we will decide the value now. Current cost of the item. Net realizable value, if I sell it now or if I buy it now, what will be the value? Based on that, we will decide on the income or expense. And the present value of future cash flows. All the income, all the expenses, and all the income that we make today in this modern business system, we try to calculate that if it will happen in 10 years from now or 5 years from now, how will be the cash flow then? So there is a term called present value today to calculate about all the investments and expenditure that we make. Based on these four, then these will be reported in the income statement. Now, cash versus accrual accounting is not much of a discussion to go into details. You can read them. The basic idea is that cash basis, they are only treating when the cash has changed hands. In the accrual, they are treating both earned and realized, all type of expenses. But in financial statements, in the accrual basis, this is the last thing we need to discuss, is that we, in the financial statements, when we are using accrual basis, we are taking into account past transactions involving payment and receipt of cash, and also obligations to pay cash or sacrifice other resources, and the resources of the entity at the reporting date. So in the accrual, we are taking into account three things: payment and receipt, obligations, and resources also of the entity at the reporting date. So this completes the theoretical framework. We had a theoretical framework that decides how accounting system works, and this chapter actually was aimed at making us clear how the accounting system is developed, the various standards are developed. So today what we covered, or in this chapter we have covered so far, and it's finished, that the financial reporting is actually affected by the objectives. Then the objectives is one parameter. The three main factors that affect the financial reporting are qualitative characteristics, the time elements, and the income, the recognition and basis for measurement. And each of them we discussed with some their own elements. So what you have to do is memorize some of the items which are very important to memorize with examples, and then we will see in each chapter how the different types of assets and liabilities are dealt in the intermediate accounting, in the advanced accounting. You have any question, you can ask me now, or we can stop for the day. I have already recorded this, so I'll put it online.